China has dealt a decisive, breathtaking blow in a global economic war that once seemed preordained to favor the United States. The tables have turned, and Washington, once supremely confident in its financial dominance, now stumbles through a crisis it never truly prepared for. As pressure mounted and Scott Bessent demanded Beijing abandon its so-called currency weapons, it wasn't the yuan that gave way. It was the US dollar that collapsed, catching markets off guard and triggering seismic tremors through the global financial system. Factories across the United States are suffocating under their own strategy, crushed beneath tariffs they once believed would force China into submission. Instead, it's American trade routes that are drying up. Shipping volumes from China have fallen by 60%. A plunge so sharp it reveals not a tactical adjustment, but a tectonic shift in global trade dynamics. Retail giants, Walmart, Target, others, already bleeding from post-pandemic logistics and struggling to restock shelves, are now staring down a full-blown crisis. Supply chains are stretched thin, inventories are evaporating, and the countdown has begun. Within mere weeks, shelves could go bare. Behind closed doors in Washington, panic is mounting, but strategic clarity remains elusive. As Trump's demands echo, urging Britain to sever economic ties with China, London listens, but does not act. The geopolitical tide is shifting, and Beijing, methodical and patient, is executing a strategy decades in the making. This is not policy tinkering. This is economic war. The United States bet on a weakening dollar to spur a manufacturing renaissance, to outmaneuver China in the global arena. But the gamble has exploded in its face. Since January 2025, the dollar has dropped nearly 10%, a staggering plunge for a currency long considered the world's anchor. But instead of factories roaring back to life, inflation has surged like a wildfire. Supply chains, still deeply entangled with Chinese components, are now costlier, slower, and more fragile than ever. The tariffs that were meant to cripple Chinese competitiveness, some reaching a punishing 145%, have boomeranged. With no alternate sources, the US is trapped in a supply vacuum of its own making. The weaker dollar has only magnified the problem. It's not fueling growth, it's fueling chaos. As Mark Zandandi of Moody's bluntly put it, you can't devalue into a supply shortage. That single sentence now defines the American predicament. While Washington wrestles with the consequences of its failed strategy, Beijing remains almost eerily calm. The yuan, far from crashing, has only slipped 3.2%. A testament to China's calculated stability. In contrast to the erratic economic spasms of previous trade wars, Beijing has sealed its financial fortress. Rather than react emotionally, China has methodically infused over $1.5 trillion into its economy through targeted stimulus. The result? Steady domestic demand, thriving exports, and a rock-solid grip on global trade. While the dollar falls into disrepair, China is reinforcing its power with surgical precision. America, once the engine of global commerce, is now sputtering. By April, shipping volumes from China to the US had cratered by 61%. The National Retail Federation sounded the alarm. If trade doesn't normalize fast, shelves will start to go empty in 5 to 7 weeks. And behind every empty container is the echo of a failed policy. Prices on consumer goods are skyrocketing. Electronics are up 32%, furniture a shocking 45%, and the Consumer Price Index for core goods jumped 1.1% in a single month. This isn't just inflation, it's a system unraveling. Washington insists the tariffs are temporary leverage. But time is no longer a luxury. The clock is ticking, and America's economic engine is grinding itself into obsolescence. The vision of a revitalized American manufacturing sector, the dream of reshoring production and reclaiming industrial might, now rings hollow. The Federal Reserve's March 2025 report paints a stark reality. Factory output is down 0.6%. Capacity utilization has slumped to 76.8%, and every metric signals retreat rather than resurgence. Costs for core materials continue to surge, especially in construction and machinery, both heavily dependent on Chinese imports. Meanwhile, the labor force is eroding. The Bureau of Labor Statistics reports a 17% year-over-year drop in manufacturing job openings. The ecosystem is broken, inputs are missing, talent is dwindling, and without them, the dollar's decline acts not as a stimulus, but as an accelerant to rising costs. Economist Mohamed Alaron called it plainly. This isn't dollar diplomacy, it's dollar dysfunction. China, meanwhile, is moving with quiet, relentless focus. Its central bank is taking advantage of the dollar's fall, using the moment to fortify its domestic financial system. The yuan remains within a stable, managed band, maintaining export strength while insulating the broader economy from global volatility. The infusion of over $1.5 trillion into Chinese banks has ensured liquidity and sustained growth. Exports are holding strong. The trade surplus is swelling. And while the US flails, Beijing is executing a long-term plan with cold precision. This isn't mere reaction. It's consolidation. It's strategy. It's dominance. In the midst of all this, Britain finds itself pinned between two giants. Washington has turned up the pressure, demanding that the UK sever economic ties with China. But the numbers tell a story Britain cannot ignore. In 2023, China supplied 7.3% of UK imports and consumed 4.1% of its exports. Cutting those ties would send shockwaves through the British economy, especially in vital sectors like electric vehicles, entire industries that depend on Chinese batteries and components. Chancellor Rachel Reeves has made the government's position clear. Decoupling from China would be economic suicide. And yet the pressure from Washington builds. In Parliament, the debate simmers, but on the ground, the London Stock Exchange still quietly prepares for Chinese IPOs. Britain walks a perilous tightrope, torn between alliance and survival. All of this points to one unavoidable truth. The global economic chessboard is shifting, and tensions are rising with every move. In the latest escalation, Peter Navarro has fired off a rhetorical grenade, accusing Britain of bending the knee to communist China, branding it a compliant servant in the Telegraph. But behind the incendiary language, a more complex picture is emerging. One where alliances blur, interests collide, and national strategies begin to diverge. As the US demands that the UK sever ties with Beijing, London is no longer nodding along. It's resisting, calmly, deliberately, unwilling to cut off access to one of the world's most dominant economic engines. Chancellor Rachel Reeves has been clear. Isolating China now, amid stagnant productivity and a ballooning trade deficit, would be a self-inflicted wound. The numbers speak for themselves. In 2023, China accounted for $62.6 billion in UK trade, nearly 7% of all goods movement. Entire sectors, from electric vehicles to pharmaceuticals, are woven into this relationship. But while Washington increases its pressure, Britain is quietly charting its own course. Rather than mimic the US push for economic decoupling, the UK is welcoming Chinese investment and even exploring the possibility of hosting a Shanghai IPO in London, an unmistakable signal of strategic divergence. A leaked cabinet memo obtained by The Guardian confirms this shift. Inside government circles, there's growing unease over America's aggressive tariff-first strategy. One senior advisor went as far as calling the US demands economically self-destructive. As Washington amps up its campaign, London recalibrates, not out of fear, but out of necessity. The era of automatic alignment is over. What's emerging instead is a UK foreign policy that prioritizes resilience over rhetoric. Still, Navarro's words echo loudly. In a speech this April, he warned ominously, "If the Chinese vampire can't suck the American blood, it will suck the UK dry." But that narrative is unraveling. Chinese foreign direct investment into the UK fell by 27% in 2024, according to the Rhodium Group. British regulators have also taken decisive action, blocking Chinese access to critical infrastructure, most notably banning Huawei from the 5G rollout, a decision spearheaded by MI5. Navarro's ideological framework doesn't fit this new reality. The UK isn't surrendering to Beijing. It's maneuvering with intention. Fiona Hill, a former National Security Council advisor, sees these decisions not as signs of weakness, but of strategic calculation. The real danger, she argues, is in mistaking provocative soundbites for actual policy. Britain sees trade not as a battlefield, but a negotiation table. And in a time when both the US and China are feeling the economic squeeze, perception matters as much as power. In the United States, the numbers are grim. GDP shrank 0.3% in Q1 25. Real wages have dropped 1.1%. Across the Atlantic, Britain faces 5.3% youth unemployment and a 22% decline in housing starts. In this environment, trade policy is no longer just about economics, it's about survival. Every deal, every tariff, every statement is shaped by a blend of foreign posture and domestic pressure. Dr. Wen T-Sung from the Australian Centre on China in the World calls it a two-level game. Leaders juggling international brinkmanship while managing narratives at home. Trump is selling industrial redemption. Reeves is selling multipolar strength and long-term resilience. Neither side can afford to blink, and so the posturing continues. Both China and the US claim to be open to dialogue, but neither wants to move first. The Chinese Ministry of Commerce says it's evaluating. The US Treasury insists the door is open. But beneath the platitudes lies a strategy of deliberate ambiguity, echoing Cold War diplomacy, when uncertainty itself was a negotiating tool. A post from a Weibo account linked to China's Central Television put it bluntly. The US must be the more anxious party. And yet, U.S. Treasury Secretary Scott Bessent has hinted that a big deal is still possible if Beijing is ready to come to the table. This ambiguity isn't a bug in the system. It is the system. Meanwhile, the financial signals are flashing red. As of April 2025, $17.2 billion in active net short positions have been placed against the U.S. dollar, up from $9.8 billion in January. Bloomberg's dollar index is down nearly 10% year-to-date, dragged by trade gaps, policy unpredictability, and shrinking imports. The yield gap between U.S. Treasuries and Chinese bonds has narrowed to levels not seen since 2006, making American assets less attractive to global investors. Morgan Stanley's Ruchir Sharma puts it plainly. This isn't just about trade anymore. The dollar itself is becoming collateral damage in the broader fight over industrial power. While the U.S. wobbles under internal shocks, China is quietly managing a slow, controlled float of the yuan, while pumping $1.5 trillion in stimulus into its economy without triggering capital flight. The contrast is glaring.